I see business owners who feel like they are doing well, but their numbers tell a completely different story. And I also see business owners who think they are struggling, when in reality, their business is much stronger than they realize. If your bookkeeping is messy, your tax return is messy. Deduction get missed, income gets overstated, and you often end overpaying in taxes. One thing I see over and over again with business owners is this. When I ask, are you doing bookkeeping? The answer is usually something like, yes, everything is in my bank statements. I track things in Excel or Google Sheets. I keep all my receipts. And let me be very clear, all of that is good. But that is record keeping, not bookkeeping. I'm Noura and I help business owners stop overpaying in taxes by making sure their financial foundation is solid. And today, I want to explain the difference because this misunderstanding costs business owners money, clarity, and control. Record keeping is exactly what it sounds like. It is keeping receipts, downloading bank statements, tracking expenses in a spreadsheet, having everything somewhere. That's important, but it's only the starting point. Bookkeeping is what happens after record keeping. Bookkeeping takes all those source documents, bank statement, credit card statements, receipts, invoices, and properly categorizes, reconcile, and organize them so that you end up with clean financial statements. And those financial statements are what actually tells you how your business is performing. Real bookkeeping means transactions are categorized correctly, personal and business expenses are separated, accounts are reconciled consistently, errors are identified and corrected, and your numbers tell the same story across the board. Bookkeeping is not data entry. The goal of bookkeeping is accuracy and clarity. Because if your books are not clean, everything built on top of them, tax planning, cash flow, decisions, pricing, growth, becomes unreliable. When bookkeeping is done correctly, you get two critical reports. Your profit and loss statement, which tells you how much money you made and how much you spent, whether you are actually profitable. And your balance sheet, which tells you what you own, what you owe, how healthy your business really is. If these statements are inaccurate or do not exist, you are making decisions blindly. This is where everything connects. If your bookkeeping is messy, your tax return is messy. Deduction gets missed, income gets overstated, and you often end overpaying in taxes. Clean books allow for proactive tax planning, not last-minute scrambling. You cannot plan strategically if the numbers you are planning with are wrong. This is why bookkeeping is not optional. It is the foundation of every smart financial and tax decision in your business. Having everything in your bank account, in a spreadsheet, or in a folder does not mean your books are done. That just means the information exists. Bookkeeping is what turns the information into usable, reliable financial statements. If you are a business owner, I want you to think about this and answer honestly. Do you actually review your profit and loss and balance sheet on a regular basis? Or are you relying on bank balances and spreadsheets to tell you how your business is doing? Drop a comment below and tell me, yes, I review my financial statements, or no, I don't. There is no judgment, just clarity. Because when your numbers are clear, everything else becomes easier. See you later.